for your listeners, if they're looking at a self-storage facility, you want to be very cognizant of what the supply is in the market, because it's basic, macroeconomics. If you get a lot of supply, prices go down. If you don't, prices go up.
Welcome back to the Richer Geek. In today's episode, I am pleased to have Kris Benson on the podcast with us. How you doing, Kris?
Doing well, Mike. Thanks for having me.
So, we're going to talk a little bit about self-storage and what you're doing in self-storage. Give me a little bit of, and our viewers, a little bit about your background and why self-storage. What made you get into it?
Sure, be happy to. So my background, Mike, is my last corporate job was in sales. So I worked for a company called Intuitive Surgical. Some of your listeners may know that. They make the Da Vinci robot. Was really fortunate to be a part of that company. Incredible technology, incredible organization, incredible people. Nothing bad to say. I got into real estate probably like many of your listeners have. There was a moment when I was about 30 that I woke up and said, nope, like I'm not doing this another 30 years. And so for me to create that passive income, the only path that I really understood was real estate. I'm not a super creative guy, but real estate's just numbers, and that makes sense to me. So we started just like probably many of your listeners have. We bought a bunch of duplexes in the area that we lived in, and did that for a little while, hated it. Realized really quickly that was not scalable for what I wanted to do as far as replacing our income. So we sold those, and I listened or read, I wish I could give credit to where I heard it, but somebody said big deals and small deals are the same amount of work. You just make less money on small deals. And that was sort of my aha, like, oh, I just need to get bigger. So we ended up building a 64-unit apartment complex. We sold all the duplexes, gave us a little bit of capital, and I was making good money at Intuitive as well. And that was sort of the light bulbs for me, is when I said, oh, this is how you make money in real estate at a little bit of scale. Could third-party manage it. So we invested in some multifamily properties in some of the primary MSAs, focused primarily on both the passive side and direct. And what was kind of happening alongside, Mike, was that my organic peer group knew what I was doing and basically just started asking, like, hey, next deal, let me know about it. And so pretty quickly, a fairly sizable amount of equity we were able to raise for the deals that we were participating in individually. And so about 5 years ago, one of the operators that we had invested with was talking about compressing cap rates and what was happening in the space and how much capital was chasing deals. And not much has changed in the last 5 years. It seems to be only more frothy. But that got me looking at other asset classes, and that's where self-storage came in. I'm a data guy, and so I went back and looked at, and I can send you the link to this for your listeners, but there's National Association of REIT data, which is a really nice comparator where you can look asset class by asset class and see how all the publicly traded REITs have done, which is a nice representative set of the asset class. And storage historically has performed incredibly well. So over the last 25 years, just under 17% a year. And once I saw that, it outperformed apartments, kind of the core four, right? Apartments, retail, office, industrial. And the next thing I wanted to see is how it had done in the last economic downturn. So 2007, 8, 9, storage did really well, lost less than 4% of its value, at least at the REIT level. And compared to apartments and retail and office, it outperformed again. So now I had this thing with a real strong historical return, some nice downside protection. And then, the third thing for me that really kind of sealed the deal, not that I don't love multifamily, but was the consolidation play that exists in self-storage. So, there's 5 publicly traded REITs in the space, and they own about 25% of the market. The other 75 is still up in the air. So I'm Reliant. We're the 25th largest self-storage operator in the US. We have 52 properties, right? So there's a lot of mom and pop operators. And so there's a consolidation play there, right? A roll-up strategy where you take a bunch of mom and pop operated facilities, roll them up into a big portfolio, and there's an exit opportunity to either institutional capital or, one of the REITs. So that's why I originally made the jump. And then, storage, that was 5 years ago. First, I was an investor with Reliant, and then about 3 years ago, they needed help raising some capital. And by this time, I had some experience in that. And so we created a partnership, and it's been an adventure ever since. I'm talking from our office in Roswell, Georgia. So our corporate office is located just north of Atlanta, about 20 miles. And self-storage is at an interesting time. We're recording this the middle of December, and obviously still in the midst of COVID, and it looks as if storage is going to come through COVID-19 relatively unscathed. So this will be two separate economic cycles that storage has performed well in. And so, right now there's a lot of capital looking to be deployed in the space. So yeah, it's been an interesting journey. I've bounced around a little bit and seen a lot of stuff.
It's fascinating. We'll get into a couple questions, and thank you. It's a very fascinating story. And I think, a lot of us that have been successful in real estate kind of have that same kind of path and that kind of same journey of you start out small and then you just kind of start bouncing upward and onward and getting into a more and more different types of units and diversifying. When it comes to self-storage, one of the questions that I always get is, it seems to be oversaturated. That's the first thing. Well, if there's a self-storage on every corner. Talk to us a little bit about that, because I would think that's probably the number one question that our listeners would have in wanting to invest in self-storage is they see a lot of them.
Yeah, there's no doubt. I think you can look back at why that development cycle happened with 2007, 8, 9, right? So, 2010, everybody started saying, wow, storage did well. We're going to get into this space. And so there were a lot of merchant builders, guys who were not, and gals who were not self-storage operators, who decided, hey, we can develop the space, get it full and sell it to a REIT, and they'll come and buy it. And there was a very nice, return on or yield on stabilized costs. So or stabilized yield on cost. So, I think that's a big part of it. The last 5 years, we've seen a substantial development cycle in the market, especially in the top 50 MSAs around the country. Yeah. There's been a lot of new development. Reliant, our particular focus is secondary and tertiary markets. So think the smaller markets. And, I think with our track record, we've proved that the REITs will go out and buy if you can in those markets, if you can provide scale. We sold a 14 property portfolio in March to one of the REITs, and it was primarily all tertiary markets. So, it's certainly something like that you have to be cognizant of. In our acquisitions team, it's one of the, the many checklists we're trying to understand is what is the market supply, what's creating the demand in the market. And, there's no magic formula for it. There's numbers that people throw around, 7 square feet per person, right? So if in a 5 mile radius, there's 100,000 people, the 7 square feet per person metric would suggest that you should have 700,000 square feet of storage to support that, right? And there's not a lot of great science to support that algorithm. So it's more about understanding the true market and what the competitive set occupancy looks like, right? If you go into a market and everybody's full, it doesn't really matter what the supply number is. It's demand. The demand is high, right? Because you got 10 facilities and all of them are 90+% full. There's a pretty good bet there's high demand there. So it's more than just one individual metric. But for your listeners, if they're looking at a self-storage facility, you want to be very cognizant of what the supply is in the market, because it's basic, macroeconomics. If you got a lot of supply, prices go down. If you don't, prices go up.
Yeah. Now, I'm seeing this trend of this, like the indoor self-storage, where it's like in a building instead of you roll up with your truck or your car and you roll it up and roll it down. Are you seeing that trend continue? Are you focusing on that type of the building type, or is the money more in just your standard self-storage unit where you roll up?
Yeah, I think what you're describing is a drive-up unit or a climate-controlled unit, and
Yeah.
especially in many of the larger markets, the new development has all been, I think 3-story glass and steel building. Everything's climate controlled. It depends. Each market kind of has its own unit mix. If you're in South Florida, right, everything's super humid. There's not a lot of drive-up because the humidity is going to mold and mildew on anything that's in a unit that's not climate controlled. We just bought a property in Midland, North Carolina that, there's probably a 75, probably 60 mix between climate and non. So, there you are.
Yep, there we go.
Sorry about that. You paused for a second. Hopefully you can edit that out.
I can. Yeah, I was getting ready to pause the recording, but yeah, we're good.
Let me just double check that it's not on my end. I think I'm good. But in any event, between climate and non-climate controlled units, and it really depends on the market. But certainly over the last, a lot of the new development that's come out is built around those climate controlled buildings.
Okay. Yeah, I was just curious about that because I'm seeing more of that, and maybe it's because I live in an urban area. Now, talk to me a little bit about the diversification of going into self-storage. We've talked a little bit about the Great Recession, and now I would think that during COVID, the demand would still be there because or maybe even greater because maybe people are needing to downsize. Talk to us a little about how and why you're thinking that it's recession resilient, but also, there's got to be this new word, virus resilient. Talk to us a little bit about that.
Yeah, I think if you think about the demand drivers of self-storage, in the industry, we talk about the 4 Ds, death, dislocation, downsizing, and divorce, right? So usually if one of those things is happening in your life, you're going to create some demand for self-storage. And, in our particular case, or with COVID-19, unfortunately for everyone, and probably fortunate for the industry, COVID-19 is probably creating a little bit of all of those, right? People are dying, people are downsizing, and people are being dislocated to new areas, and maybe people are getting divorced because of COVID because they're spending too much time together. But generally those are the demand drivers, and they're creating more of those. So if that happens, generally demand's going to go up. So what we've seen, across the industry, our portfolio is rather small. 52 properties across 8 states, right? So we see a very small portion of the asset class, but we look to the REITs to kind of give us insight into what's happening at a national level. And they're seeing the same thing in that April, May, June was slow as people kind of were huddled and locked down and wondering what the new world was going to look like. And then, July, August, September, October, so far so good. The demand came back. Our occupancy across our portfolio actually went up, as did revenues. So, we're seeing demand drivers. One interesting statistic, though, that we don't necessarily know what it means yet is the average tenure of a tenant is longer during COVID than it was previous. So, if you think about storage, one big difference versus residential or multifamily is that the leases are 30 days. So we see a lot of churn of tenants. And what's interesting is people are staying longer right now. And we don't know if that's kind of we call it ghost occupancy, where once the virus, clears out, maybe those people all leave, or is this a different consumer behavior? And so we don't know that yet, but time's going to tell, and the data will tell that story.
And it's a very good future outlook. You're thinking it's not going to go down for any reason, that it's going to, in the new world, that you think you're going to see a very strong future.
Yeah, I mean, Mike, what I would say is one of the things that COVID accelerated for us as an operator was touchless leasing. So the ability for someone to do everything online, and literally, if they don't want to talk to someone, they don't have to. So there's going to be more technology deployed in the space to offer those kinds of things. But generally, we don't see consumer behavior changing. I mean, COVID's causing a lot of people to move right now, right, and move into new areas, and the net migration out of the Northeast and kind of the Rust Belt states into the Southeast or the Sun Belt states is real. So, time will tell. I certainly can't predict the future, but we don't think there's going to be a major, consumer behavior change because of COVID.
Okay. Now, a little bit about Reliant Investments. Is what you do more of a REIT style? Is it a fund? Do you do syndications? Tell us a little bit about what type of investment that you offer our listeners.
You're saying how we raise equity, Mike?
Yep.
Yeah, so right now we're raising equity through a fund vehicle. So, the best way to describe it is think mutual fund of self-storage property. So we used to, in the past, syndicate individual deals. So, we would take to our investor base, hey, we're buying a property in, Wilmington, North Carolina. Would you like to invest in that? And then in 2019, we launched our first fund with the idea behind it of, for our retail investors, guys and gals, maybe they deploy $100,000 in the space. We wanted to be able to create that diversification for them. And so the fund does that. So fund one, we ended up raising $47 million, and there were 11 properties in the fund. So it gives the investor ownership in all 11 properties, and that's good and bad, right? It smooths out the returns. So if one property goes down the tubes, the performance is buoyed by the other, but the opposite happens as well. If one property absolutely crushes, it's pulled down by the other property. So it kind of smooths out those returns. So right now we're doing fund two, essentially a very similar structure. We plan to raise $50 million. We have 2 properties in the portfolio today. A third closes in January, and then we have 4 more under contract that are in the due diligence process, which will get us to 7. Hopefully we'll have all of those closed by the end of Q1, beginning of Q2 of 2021.
And is most of your acquisitions, it seems like you're closing on ones that are already built, that are already there, or are you ground up?
Yeah, so our sweet spot really is the value add play, where we're buying currently cash flowing asset and doing some forced depreciation model to it. That could come in a number of formats. It could come in us building an additional building, some additional square footage and getting that leased up. And that's where the growth of NOI comes from. It could be a management value add where, we're adding ancillary income items like U-Haul truck rental and tenant insurance programs and, retail sales of boxes and locks and moving blankets, all that kind of stuff.
Yeah.
And sometimes the operational value add is lease up. So we'll buy an asset where the current owner completed an expansion and we take over at 0% occupancy for that building, right? And our job is to get it leased up. So I would call us an opportunistic self-storage operator. We'll look at almost anything, but that value add play, although we do some ground up development, that value add and stabilized deals is really where our sweet spot is. And Fund 2, all of the deals, those 7 that I mentioned, are a combination of either value add or stabilized. None of those are ground up development deals.
Now, what is the real return on investment that investors can expect with your type of, based on your data and what the investors are currently doing?
Sure. So I'll start with our track record. We've sold 22 properties in our history. And our average, it depends what metric you want to look at, but our average project level IRR, for example, is in the 40s, which is really, really high. But our timing was really good. We had 2 things kind of happening at the same time. we were buying properties at a perfect time, and we were doing value adds to those properties, and cap rates were compressing. Storage was becoming more valuable because more people wanted it. So we're generally underwriting, like our fund now, Mike, is projected to be a 6-year hold period, and between 12 and 15% a year, including the profits from sale. So, the cash flows, current yield, so what we plan to pay right now, are between 4 and 7% a year.
Mm-hmm.
And then upon exit, you'll get the rest of that pop, and we expect the returns to be, on a $100,000 example, we expect to return between 172 to 190,000 to you, including your principal. So 72 to 90% over a 6-year hold is the projected return for Fund 2. And
do you leverage?
We do, yeah. So generally, our leverage is between 65 to 70% loan to value. Mm-hmm. Depends on the project and the lender, but we endeavor to not have the fund portfolio be above 70% loan to value. Fund 1, we ended up at the 11 properties. I think it was 68% LTV. So we're generally in that ballpark.
Good. And we're getting close on time before I go to another one. Most importantly, how can all of our listeners get a hold of you, get more information? Where can they find you? Yeah, sure. I would say our website's a good place to start, reliantinvestments.com. I'm also on LinkedIn, Mike, Kris Benson. It's Kris with a K. If you Google me with Reliant, you'll find us. On LinkedIn, we're fairly active, post some stuff there. Mm-hmm. But on our website, there's a bunch of information. There's some free education on just real estate investing on a whole. You can sign up and get all the videos. It's free. You just have to enter your email address. And then certainly if you're interested in more on our investment platform, there's an Our Investments page that will walk you through, and specific right now to give you more information on Fund 2. Mm-hmm. And, for all of our listeners, and you can hit on this, Kris, to wrap up, the tax deferred strategies also are good. Some people think, well, it has to be multifamily or it has to be, single family, but you can get some nice tax deferment also with self-storage. It's the same, right? Are you saying from a depreciation standpoint, or a 1031 type of structure? Well, with the K1s, with depreciation, all that, it's not just on. People think, they were always surprised that I get depreciation on hotels. You also get depreciation on your self-storage. Yeah, that's correct. So you participate as an investor at the LLC level. So you'll get a K1 at the end of the year. And just like you share in your pro rata share of the revenue of the fund, you also share in your pro rata share of the depreciation. So in many cases that offsets the income. And like you said, can create a loss from the IRS's perspective on that K1 income. And as far as your fund, accredited investors only, is there a minimum? Talk to me a little bit about what they can expect when they go to the website. Yep, for sure. So it's a 506C offering, meaning that all the investors do have to be accredited. Mm-hmm. And the investment minimum is $50,000 for a Class C share of the fund. We have 3 classes of share. So generally, if you're accredited and interested, by all means, reach out. We're happy to get you some more information. Sounds great. Well, Kris, I appreciate you coming on today and telling us a little bit more, I should say a lot more, about self-storage. And for all of our listeners out there, please check out their website and connect with Kris on LinkedIn. Thanks, everybody. Thanks, Mike.